So most clients have two goals when they see me and we're here to discuss their estate plans. Number one, they want to minimize costs, especially probate fees and other estate-related costs. And secondly, they want the proceeds of their estate to be paid out to their beneficiaries as quickly as possible. So a common planning strategy for assets, and I'm talking either investments or property, in the past was to use joint ownership. Adding another name to an existing asset so that upon death, that asset is now owned by the remaining owner or owners, bypasses probate and the estate. However, before transferring any asset to joint ownership for estate purposes, it's important that you consider a few issues that may change your mind. First, there are the tax consequences. When you add another owner to an existing asset other than your spouse, it's considered a taxable disposition. This is especially true and most common for cottages. Any gains or growth will be then triggered, even though the property is not sold, and the taxes will be owing the following year. Secondly, there's a loss of control. When you've added more owners to an existing asset, you may need more signatures in agreement if you want to make changes to that asset. Thirdly, there is increased liability for this asset for you as the original owner. Let's say, for example, you add your son and daughter to an existing investment account in order to, for the sake or the purpose of simplifying your estate. But what if that son or daughter goes through either a divorce or bankruptcy in the future? Their share of that asset will be subject to any creditor or family law equalization claims. And fourthly, and the newest, is the impact of the estate information return in Ontario. Using joint ownership used to be black and white. You named other owners to an asset after all the other considerations, and that asset simply passed on to the other owners. However, in Ontario, as of January 1st, 2015, we have a document, rules in place through the Ontario Estate Information Return. And in essence, what that document means for estates in Ontario, what used to be black and white is now a gray area. And joint ownership is not the simple tool it used to be. So here's a court case back in 2021 that tells the story the best. The court case is Komolsky versus Komolsky. There was a widowed father and his sons. His original will split his entire estate equally between his two adult sons. At the bank, though, the father had an investment account where only one of his sons was listed as joint owner. When the father died, the bank allowed the one son to assume full ownership of this account, and this son, sadly, did not share the proceeds with his brother. The brother, who had been left out, eventually sued his brother, sued the lawyer, and sued the bank, and won back his share of this account. So the court and the judge ruled as follows. When an adult child is named joint owner of a property, such as a bank account, to which they have not contributed, it is presumed that the adult child is holding the property in trust for the parent's estate. And as such, in this case, Dad's will and his wishes came to play, and the asset was to be split between both brothers. So the good news is for the clients who wish quick transfer of their assets and to reduce costs, which is everyone's common estate planning goal, there is a solution that avoids all these complications. It's simply choosing to use investments from an insurance company, such as a GIC, and naming beneficiaries. That's it. Upon death, the assets bypass your estate, bypass probate. They're paid out directly to the beneficiary within 10 to 15 banking days. Plus, and most importantly, you avoid all the complications that I have just mentioned. And if you're interested in learning more to find out if this is applicable to your situation and your estate plans, please contact me. I'd be more than happy to assist.